Hello everyone and hope everything is going well. Hello everyone, hope everything is going well. Today our topic will be about key factors that affect the market. So this webinar aims to help participants master the important factors and to trace while in the process of decision making. So very important to know the material and tips provided within this webinar save you big losses and a year of misery. At the same time, it helps you advance your trading journey and elevate your significant rapidly. So finally, for this last part of this course, we'll take at some other factors to consider as part of your Forex fundamentals, economic indicators and announcements, other factors that affect the Forex market, finding events with the Forex.com economic calendar. So economic indicators and announcements. The GDP, NFP, and CPI releases might be some of the most important dates for currency traders, but there are a lot more markets moving events to pay attention to. So here's a quick guide covering three important economic indicators: consumer and business sentiment reports, PMI, and retail sales. So number one, consumer and business sentiment report. Multiple organizations are constantly surveying consumers and businesses leaders to create sentiment reports. While the number of reports they produce is they all play their part in shaping the market's expectations for the future. So why are consumer and business sentiment reports important? An economy needs businesses and consumers to spend in order to thrive. If businesses and consumers are feeling apprehensive about the economy, then spending tends to be lower, which may impact growth, employment, and inflation down the line. As such, these reports tend to be leading indicators, while employment and inflation figures are reported on past quarters. Sentiment reports can give you an insight into what's going to happen next. Number two, Purchasing Manager Index, PMI. Purchasing Manager Indices measures the prevailing direction of economic trends in a given industry. According to the view of its purchasing managers, they are used as an indicator of the overall health of a sector. Like price indices, there are typically multiple different PMIs released for any given economy. A PMI figure of above 50 indicates that managers believe that their business is performing better in the current month than the previous one. If it's below 50, then managers have seen less activity this month than last month. If it's at 50, then the current month is on par with previous one. So we have these three differences. So why are PMI important? PMIs are used to a quick on-the-ground assessment of how a sector is performing from the people working within it. If a key sector in a country is stalling, then the economy may soon follow. On the other hand, its thriving growth could be on the horizon. 3. Retail and vehicle sales. Retail and vehicle sales are two indicators that measure demand for finished goods and demand within the car industry respectively. So why are retail and vehicle sales important? As we've seen, economies run on consumer spending. Retail and vehicle sales offer a direct measurement of spending, informing traders whether consumption is trending up or down. Retail sales figures give a much broader view of spending and are typically compiled by the government each month. While narrower, vehicle sales can be a little bit more expedient as they are released by businesses themselves. Many traders believe that vehicle sales can offer an insight into general spending, so will use them as a leading indicator for the retail figure. Other factors that affect the Forex market. Forex fundamentals analysis isn't all about economic data through. There are four other considerations to take into account. So, government announcements. Government announcements are responsible for fiscal policy, which also has a major impact on currencies to fund a new infrastructure project. For example, the government will have to borrow money in the form of bonds to sell to investors. Fiscal stimulus measures are agreed upon by governments, and sometimes a vote needs to take place to make the stimulus into law. It pays to keep up to date with breaking news events to ensure you don't miss these crucial decisions. 2. Market sentiment. It is simplest form. Fear can turn a falling instrument into an all-out panic, and greed can turn a rising market into a bid buying spree. The crisis in the Eurozone, particularly in Greece in the 2010s, led to the extreme selling of euro as fear dominated mainstream thought. Soon after, though, greed kicked in and drove the currency to levels that were determined uh, to employment and inflationary dynamics. The European Central Bank had to force devaluation through a variety of market mechanics. While it may be easy to point out the effects of fear and greed on markets after they have acted upon them, choosing the moment when they flip in the present is difficult. Number 3. Not all news events are equal. For instance, as a general rule, employment reports tend to move markets more than a manufacturing sales report, and a retail sales figure riles things up more than a monetary supply report. The economic calendar is a great resource to help you determine which reports provide the most punch, while not all important news events move the needle when they happen. They have the highest probability of doing so, and knowing when the markets will move can be one of the greatest advantages you have as a trader. Number 4, most of the volume traded in FX options is for the international business purposes, meaning that businesses can hedge the risk of currency value changes. However, a growing segment of the volume traded is going towards speculation. Double not touch (DNT) options are the specific type of option that interests FX traders at the most. These types of options are usually placed on round numbers in popular currency pairs like the Euro-USD or USD-JPY and are often targeted by extremely liquid investors. If a currency pair moves quite a bit and it nears these psychological points of interest, sometimes it surges beyond that level and then retreats away from just as quickly. Other times the market gets close but never quite gets there before breaking away from that level. Thank you for joining our session today and hope to see you next week.